Hey everyone, welcome back to the deep dive.
Yeah.
We're here again to, slice through the jargon, cut through the noise, and really get you informed. Today we're plunging into the Q1 FY26 financial results of Tata Elxsi. They're a company right at the cutting edge, design and technology services. And this isn't just about spitting out numbers, it's really a story of resilience, I think, and strategic shifts, especially with the global economy still, well, feeling the squeeze.
That's absolutely right. And our mission for you, the listener, is to extract those really crucial nuggets of knowledge and insight. We've meticulously gone through it all, the detailed financial reports, investor presentations, and yeah, even the full earnings call transcript.
So you've done the homework.
We have. And this lets us understand not just what happened, but the strategic moves, the why behind these numbers, and importantly, what these results truly mean for a company like Tata Elxsi operating in such, well, dynamic sectors.
Okay, let's unpack this then. We should probably start with the top line figure.
It makes sense. Tata Elxsi reported an operating revenue of Rs 892.1 crore for Q1 FY26. Now, when you look at that, it's actually a 1.8% decline quarter on quarter in actual currency. And if we strip out the currency fluctuations, it's a 3.9% QoQ decline in constant currency.
Right, and that constant currency figure, it's crucial here. It really strips away the noise of exchange rates. It reveals that even without those fluctuations, they faced an underlying decline. So it tells us that the economic squeeze is genuinely hitting core operations. It's not just being masked by currency shifts.
That makes sense.
And what's particularly insightful, I think, is how this connects directly to what the CEO said on the call. He described the quarter as, and I quote, challenging across key markets, with macroeconomic uncertainties, industry and customer-specific issues impacting R&D spend and decision-making cycles across geographies.
Oh,
That's pretty frank.
yeah, no kidding. Those revenue numbers definitely paint a challenging picture. But what's really striking maybe is how that translated into their profitability, especially when you compare it to last year. Can you break down those margin shifts for us?
Absolutely. So their EBITDA margin for Q1 FY26, it stood at 20.9%. Profit before tax, or PBT, was at 21.1%, which amounts to Rs 196.3 crore. And the profit after tax, PT, that was 15.5%, or Rs 144.4 crore. Now, if we connect this to the bigger picture, just a year ago, Q1 FY25,
Right.
their EBITDA margin was way up at 27.2%, and PAT margin was 19.2%. So yeah, that's a pretty significant drop.
Wow, okay.
And the company's initial explanation for this pressure, it points to a combination of that top-line degrowth we mentioned, and also what they're calling transition investments for the large deals won last quarter.
Okay, transition investments. What does that actually mean in practice? Why does it hit the bottom line so hard?
Yeah, good question. Think of these transition investments as like the upfront costs of getting new complex projects off the ground. It's a bit like moving into a new office, right? There's always that period of disruption, maybe training new staff, setup expenses, before you're really fully productive and profitable.
Okay, the initial setup pain.
Exactly. That temporary drag is precisely what we're seeing reflected in their margins here. So the critical question now is, does this quarter's drop suggest, a deeper structural issue? Or is it really just a temporary blip tied to these investments, getting those big deals running? The company is definitely betting on the latter.
Right. It's clear the overall numbers are facing some headwinds. But where were those challenges and maybe the strengths most acutely felt? Let's drill down into the detailed performance of their key business verticals. Maybe start with transportation. It makes up over 50% of their total revenues. And it showed a surprisingly strong recovery, actually, 3.7% growth QoQ in actual currency, achieving a flat performance in constant currency terms.
Yeah, what's truly insightful there, I think, is that even as the whole automotive industry is grappling with uncertainty, it's in a state of flux, Tata Elxsi's resilience seems to come from aligning squarely with the OEMs. That's the original equipment manufacturers, the actual car makers, and specifically with the software-defined vehicle, or SDV, trend.
Okay, the SDV focus.
Right. This isn't just about winning deals, it actually signals a fundamental power shift. You see, car makers are increasingly reclaiming software control from those traditional Tier 1 suppliers.
Oh, the ones who used to provide the whole module.
Exactly. Those guys are under stress globally. Tata Elxsi is positioning itself as a crucial partner, an enabler of this transformation for the OEMs. And those large deals they mentioned, like with Mercedes-Benz, another European OEM, and Suzuki, they're now ramping up. So about, 72% to 75% of the revenue now comes directly from OEMs. That really underscores this shift.
So a pretty strong story in transportation, despite the wider industry wobbles. How about the media and communication business, MCV? That contributes about a third of their revenue. It saw a decline, though. 5.5% QoQ in constant currency.
Yeah, that dip, it was primarily down to those very transition investments we just talked about. To clarify for this segment, these are often consolidation deals. So the initial commercial terms may be lower per unit rates. They temporarily impact the revenue figures. But the key is they are long-term commitments. We're talking maybe 3-year contracts, for example.
So short-term pain for long-term gain,
Yes.
potentially.
That's the idea. The industry environment here is definitely challenging, though. There's M&A activity, declining net new subscribers for many players, and a big focus on what they call efficiency-driven deals,
Sufficiency-driven,
meaning less about exciting new growth projects and more about helping clients optimize what they already have, doing more with less, essentially. This often leads to, lower per unit rates and a focus on cost saving rather than big top-line revenue expansion for Tata Elxsi from those deals. Still, despite these headwinds, management does anticipate growth for this segment in Q2 FY26.
Okay, interesting dynamics there. And finally, their healthcare and life sciences HLS business, that's about 12% of revenue. This segment experienced a 6.7% QoQ decline in constant currency. What's the story there?
Well, the decline there was mainly due to, and this is specific, tariff-related impact on medical device engineering programs and spend with 2 key customers in the U.S.
So trade tariffs hitting projects.
It seems like it. New import duties or regulatory changes in the U.S. directly impacted their project scopes and profitability with those key clients.
Yeah.
It really highlights how sensitive that segment can be to specific market regulations. But there is some positive news. They had 2 key wins in the quarter: a global pharma and biotech leader from Europe and a medtech leader from Japan. That signals they're working on diversification.
Good to see. And the outlook for HLS?
Management is anticipating recovery, but probably more in the second half of FY26 for this one.
Right. Okay. It's clear that each vertical has its own unique pressures and all opportunities too. But beyond the numbers, what strategic moves is the company making on the ground, especially around its most vital asset? Its people, its talent. We saw a headcount decrease and attrition tick up a bit.
Yeah, that's a critical question, isn't it? How do you manage talent in a challenging environment like this? Their approach, it isn't aggressive hiring right now. Instead, they're leveraging what they call a decent bench capacity. That's basically their pool of available unassigned employees. The plan is to improve utilization there, get those people onto projects, and help margins as revenue picks up.
So using the existing team more effectively.
Exactly. They did confirm, though, that wage hikes are still planned, probably from Q3 FY26 onward, so around the October timeframe. And it's also worth noting their business model remains majority offshore. It was 73.1% in Q1 FY26.
That's an interesting balance. Lower headcount overall, but still planning wage hikes. It suggests a certain confidence, maybe.
Yeah.
Let's talk about their strategic plays then. What about new deal wins, partnerships, anything that really stands out?
Oh, definitely. The breadth of their new deals is quite fascinating, actually. It really shows the company's strategic focus, where they're placing their bets. One standout is a strategic multi-million-dollar design digital deal. This is with a U.S.-headquartered global tech leader. It's for a major data and insights program focusing on next-gen AI and product feature development.
AI focus?
Yeah, and beyond that, they secured a deal for a next-gen off-road vehicle platform. This includes advanced 8AS features, plus a connected vehicle platform for a global agri-machinery manufacturer. So, diversifying applications there.
Interesting. Any key partnerships?
Yes, they teamed up with Infineon Technologies. The goal is to accelerate EV innovation in India, specifically focusing on ASIL-D safety standards.
ASIL-D.
Yeah, that's the highest level of automotive safety integrity. It's crucial for mission-critical systems like advanced driver assistance, braking, steering, that kind of thing. And in a more unique move, perhaps, they forged a strategic partnership with ECOSEP. That's the European College of Sport and Exercise Physicians.
Sports medicine, really?
Yeah. To apply AI and machine learning in sports medicine. For advanced diagnostics, injury prevention, it's quite innovative. All this clearly demonstrates their continued push into these cutting-edge areas: AI, SDV, EV, and even applying tech in new domains like sports.
And it seems their global presence isn't just about closing deals. They're getting some serious recognition too, right? I saw the Bharat Pavilion at the World Expo 2025 in Osaka. Tata Elxsi was involved in design, tech, content integration. For that, it was ranked among the top 5 pavilions globally. That's impressive.
It is, and they also snagged a Best in Linear Distribution Award for MBC/NOW, which is powered by their own T-Play OTT platform.
Okay.
And these achievements, they connect directly back to the company's core identity: design-led technology services. It really highlights their participation at key industry events too, like the RDK Tech Summit 2025. They showcased Wi-Fi sensing for elderly monitoring there and also legacy device modernization. And at Waves 2025, the Prime Minister of India actually visited their pavilion. They're showcasing things like game sense and dynamic experiential content.
Wow, high-profile visit.
Yeah. And it also emphasizes their role in the Battery Aadhaar initiative, which aligns with India's sustainable mobility goals. All of this, taken together, really illustrates their active role in, trying to shape the industry's future.
And internally, they seem to be fostering innovation too. Their tech hackathon, Teleport Season 2, apparently attracted a massive 17,000 registrations.
70,000, yeah. Pretty huge.
And the winning themes were quite cutting edge. Things like a robotic solution for inspecting rail wagons using AI and sensors, and a Gen AI-based solution for developing ADAS features. They also just launched their reimagined website, I noticed.
Yeah, all that reflects, I think, a consistent investment in nurturing future talent and really showcasing their AI-first, design-led proposition. However, this does raise an important point for you, the listener. While AI is obviously a huge buzzword everywhere, exactly, the CEO actually expressed a rather guarded view on its immediate dramatic impact on headcount, specifically in engineering roles. He noted that, legal issues, liabilities, they mean it's not a panacea for all issues. So in essence, they're embracing AI strategically, yes, but with a clear eye on the practical realities and potential pitfalls, not just jumping on the hype train without thinking.
A dose of realism, perhaps?
Yeah.
Okay, so we've covered the numbers, the verticals, the strategic plays, the innovations. What does all this mean for Tata Elxsi's future, particularly for Q2 FY26 and the rest of the financial year? What's the general outlook?
Well, the company doesn't give specific, number guidance for revenue or profitability, but the CEO did express confidence in, quote, steady improvement in bottom line and margin through the year. The expectation is for their two largest businesses, transportation and media and communication, to return to growth in Q2 FY26 and beyond, with healthcare, as we said, recovering more in the second half of FY26.
Okay, management expresses confidence. But given those persistent macroeconomic uncertainties they cited earlier, and you mentioned the fluid situation at JLR, how realistic is that recovery timeline? Are there any, potential red flags you're seeing that could derail this optimistic outlook?
That's a very fair question. The optimism seems to stem mainly from the ramp-up of those large deals we discussed earlier. As those transition investments mature and the projects start contributing revenue properly, they expect to see that bottom line improvement kick in. Historically, these large deals, they can take maybe 2 to 3 quarters to become fully accretive to margins.
So patience is needed.
Patience is needed, exactly. The red flag, if there is one, would be if the macroeconomic environment gets significantly worse, or perhaps if the ramp-up of these specific large deals is slower than they anticipate. But for now, they seem confident that the pipeline, the work they've already secured, is strong enough to drive that recovery.
Okay. And on the crucial topic of margins, getting back to those historical levels, around 29–30% EBITDA, what's the detailed strategy there? How do they climb back up?
Right. The management is aiming for a gradual uptick, not a sudden jump, but gradual improvement over the next 3 quarters. The medium-term aspiration is definitely to return to those historical levels.
How?
Well, primarily by improving utilization, getting more billable work out of their existing bench of employees as the business picks up, and also mitigating those initial margin pressures from the large deal transitions as they mature. It's also worth noting, though, that the tax rate is moving high north of 25%.
Ah, why is that?
It's due to the expiry of some SEZ benefits, special economic zone benefits, so that will inevitably impact overall profitability, the net profit, going forward. It's an external factor they have to manage.
Got it. Let's just delve a bit deeper into transportation again, since it's so vital for them. How are they managing those specific areas, like their largest customer, JLR, and that Tier 1 segment? You mentioned both have shown some fluidity.
Yeah, the situation at JLR, their largest client, is indeed fluid. The company expects to basically maintain at the current level there, maybe with some incremental growth, but certainly not aggressive growth from JLR specifically right now. And the Tier 1 supplier business globally, as we discussed, remains stressed. That's because the OEMs are taking software ownership. It's a structural shift.
So how do they grow transportation overall, then?
Well, the strong momentum they're seeing from other OEM clients, particularly in Europe and Asia, seems key. That's driven by those ramping large deals and also new customer conversations they're having. This momentum is expected to lead to positive growth in the transportation business overall, effectively offsetting a Tier 1 weakness. The U.S. OEM market, however, that remains slower for them, they noted.
Okay, balancing act there. Finally, let's look a bit further down the road. What's the company's long-term growth and diversification strategy? Beyond its current core verticals, are they looking at completely new frontiers?
They absolutely are. They're committed to expanding into what they call adjacencies for each existing vertical. So, new areas closely related to their current work, leveraging existing skills. But what's perhaps more noteworthy is their active investment in a completely new vertical, aerospace and defense.
Interesting. How developed is that?
They already have a 150-person team, apparently, and capabilities in areas like drones, eVTOLs, those electric vertical takeoff and landing vehicles you hear about. Now, they acknowledge it's a long lead time business, meaning it takes a while for projects to mature and generate significant revenue. But their aim is for at least 50 CR revenues this year from it.
50 crore this year. That's not insignificant.
No, it's a start, and they anticipate significant business in this domain in the next 2 to 3 years. They seem quite optimistic about the margins here too, maybe due to a differentiated approach, leveraging their design and digital skills in a high-value sector.
Right. So, to sort of wrap up our deep dive here, Tata Elxsi's Q1 FY26 results, they really reflect a company navigating these global uncertainties with, well, resilience. Strategic large deal wins are key, but they carry those initial investment costs we talked about. And there seems to be a clear, albeit gradual, path laid out for recovery in key verticals. It's a dynamic balance, isn't it? Challenges and targeted growth initiatives.
Absolutely. And this raises, I think, an important question for you, the listener, to maybe chew on.
Yeah.
In a global economy that's characterized by constant flux, constant change, how crucial is a company's ability to not just adapt, but to actively try and shape its future? Through these strategic niche investments like aerospace, through strong partnerships, and through a, let's say, cautious yet confident long-term vision, particularly in these cutting-edge areas like AI, software-defined vehicles, electric vehicles. What deeper questions do these results spark for your own understanding of industry trends? Especially maybe how companies manage that short-term pain, like lower margins from big deals, for potential long-term strategic gain.
Definitely food for thought. We encourage you, as always, to continue your own deep dive into the information that shapes our world. Until next time.